Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A tech bloodbath rocks Wall Street as the Nasdaq plummets 1.8%, triggering a capital exodus from growth to value. Is the AI party officially over, or is a historic buying opportunity emerging from the chaos? Second, inflation slowdown masks a deeper crisis. Flawed data triggers a high-stakes showdown between the White House and the Fed. Is the market celebrating a phantom victory? And will the central bank risk its credibility on a statistical illusion? Finally, Micron skyrockets over 10% in a historic surge. A sold-out through 2025, bombshell reveals a new AI choke point beyond Nvidia. This isn't just a stock pop, it's a warning shot for a new wave of tech-driven inflation. Warning signal. The US equity markets are experiencing a notable shift as tech stocks face a sharp pullback. The S&P 500 declined by 1.2% to 6,721.43, while the Nasdaq tumbled 1.8% to 22,693.32, signaling a significant sector rotation. Why is this happening? A confluence of factors is driving this action. Concerns over AI stock valuations, a stronger than expected inflation report, and hawkish Federal Reserve guidance are all contributing to the pressure on technology and growth stocks. Let's break it down. The recent Consumer Price Index, CPI data, revealed a 2.7% year-over-year increase, stronger than anticipated and reinforcing the Fed's cautious stance on future rate cuts. This shift in inflation dynamics is crucial because it suggests that the disinflationary trajectory, while present, is not aggressive enough to warrant rapid policy easing. The Fed's messaging highlights a data-dependent pause, which implies a more measured approach to future rate adjustments. This is a critical pivot as the market had been pricing in more aggressive cuts. On the capital flow front, trading volumes surged to 17.92 billion shares, exceeding the 20-session average, indicating that institutional investors are actively reallocating assets. The CBOE Volatility Index, VIX, rose to 17.62, reflecting increased market uncertainty but not yet reaching panic levels. This indicates a recalibration of risk rather than a full-scale retreat from equities. Valuation-wise, the divergence between the Dow's relative stability and the Nasdaq's decline underscores a shift from growth to value. Investors are shedding high valuation tech stocks and rotating into sectors like energy and consumer staples. The Energy Select Sector SPDR Fund, XLE, gained 2.2%, benefiting from lower oil prices and highlighting the market's pivot towards sectors with stable earnings and dividends. Delving deeper into individual sectors, we see pronounced weakness in technology. Oracle Corporation's 5.4% decline following concerns over its data center investment plans triggered a broader sell-off in AI and semiconductor stocks. Broadcom fell 4.5%, highlighting investor anxiety over capital spending sustainability. Conversely, Nvidia emerged as a relative safe haven, maintaining investor confidence due to its dominant market position in AI infrastructure. Now, let's talk strategy. Sound investment decisions are built on clear analysis and risk awareness. Here's what to consider. In the short term, if high valuation tech stocks continue to face pressure, it may be prudent to reduce exposure to these areas. Consider reallocating into financials and energy sectors that benefit from a stable interest rate environment and lower energy costs. ETFs like XLF, which tracks major financial institutions, and XLE, focused on energy companies, could offer attractive opportunities. For those with a medium-term horizon, the current environment may favor a shift towards dividend-paying value stocks. With the Fed signaling a pause, companies with robust earnings and stable dividends, particularly in the consumer staples sector, could provide both income and defensive characteristics. Look at ETFs like XLP, which tracks consumer staples, as potential vehicles for this strategy. In terms of risk management, keep an eye on key levels such as the Nasdaq at 19,500 and the 10-year Treasury yield at 4.3%. These indicators will be critical in assessing market sentiment and potential shifts in investor behavior. For conservative investors, maintaining higher cash positions or increasing allocation to defensive sectors like utilities might be wise. Meanwhile, growth-oriented investors should selectively hold on to quality tech names like Nvidia which offer stability amid sector volatility. As we move forward, stay alert to next week's economic data releases, particularly Thursday's employment figures, which could further influence Fed policy expectations and market dynamics. With that framework in mind, let's examine today's key developments and how they set the stage for potential opportunities ahead. The most unexpected news in the finance world today has to be a surprise inflation report that just sent a jolt through the markets. It shows US price increases slowed unexpectedly, fueling a high-stakes showdown over interest rates. This print drops straight into the Fed's internal three-way split. We discussed previously some arguing cut, others don't cut, and a few cut even more. The latest figures from the Labor Department show prices rose just 2.7% over the year to November, down from 3% in September, and lower than many analysts predicted. Lower inflation is a big deal. It means your money goes further, and it gives the Federal Reserve a reason to consider lowering interest rates, which makes it cheaper to borrow for cars, homes, and business investments. As we've talked about, if policy isn't truly restrictive, cutting can feel less like easing off the brakes and more like tapping the accelerator, exactly the concern some Fed voices have raised. This cooldown comes amid intense political pressure. In a primetime address, Donald Trump claimed that inflation had, quote, stopped, and called on the Federal Reserve to deliver lower borrowing costs. He even promised to name a new central bank leader who believes in lowering interest rates by a lot. We previously analysed how Chair Jerome Powell has framed the risks, highlighting a softer labour market, while dissenters warned the real danger is still stubborn inflation. So the thing is, this intense political pressure, using a single potentially flawed report as justification, is a direct test of the central bank's independence. If the Fed is seen as making decisions to appease political actors rather than based on sound economic data, it could damage its long-term credibility. But that's not the whole picture. The real turning point is the report itself comes with a major asterisk. It was delayed by a US government shutdown, which prevented the collection of some data. One chief market strategist, Art Hogan, called the report positive that comes with an asterisk, while an economist at Oxford Economics, Bernard Yaros, warned the easing might be more noise than signal. Now get this, the shutdown distorted the numbers because a major driver of inflation, housing costs, couldn't be collected on time due to the 43-day halt. When they finally gathered the data, it was during a holiday period with more discounts. To fill the gaps, they use a statistical estimation method called imputation. The risk here is an artificially low reading for housing costs, which could mislead the Fed. Interestingly enough, another hidden factor is at play. The recent selective rollback of some tariffs on Chinese consumer goods may also be creating a temporary artificial dip in goods prices. For our Chinese-speaking listeners, while lower US tariffs can temporarily boost demand for Chinese exports, this effect can mask underlying US price pressures and create future volatility for the US dollar and, in turn, the RMB exchange rate. The situation presents a fascinating duality. On one side, you have all these expert warnings about bad data, while on the other, the market doesn't seem to care. Financial markets have immediately interpreted this soft CPI report as permission for the Fed to start cutting rates. This creates a powerful feedback loop, pressuring the Fed to deliver those cuts, regardless of whether the data truly justifies it. As Ellen Zentner of Morgan Stanley put it, inflation may still be above target, but today's data made the opening for additional rate cuts just a little wider. So, what should we watch now? The key will be the next few economic reports, especially the PCE price index, which is the Fed's preferred gauge. The big question is whether the Fed will stick to its data-driven approach or bow to the combined pressure from politics and the market. We were just talking about the Fed's battle with inflation, and now we shift to a part of the economy that might be creating a whole new inflationary headache. A top executive at a major tech firm went on the record with a phrase that sent its stock soaring over 10%. We are more than sold out. A while back, we analysed how downstream manufacturers were starting to capture real AI demand. What really brought this to a head was the realization that the choke point has now shifted even further upstream into memory. The product they're sold out of is called high bandwidth memory, or HBM. Actually, HBM is a critical component for the entire AI revolution. Think of it as a multi-lane superhighway for data, allowing AI processors to access vast amounts of information at incredible speeds. That bombshell statement came from Micron Technology's business chief, Sumit Sadana, as the company revealed The AI gold rush has created a furious, overwhelming demand for its memory chips so high, Micron says it has a significant amount of unmet demand. And this isn't an exaggeration. Micron's entire production of this advanced HBM is reportedly sold out through all of 2025. Continuing our last discussion on sovereign AI, these nation-state build-outs are amplifying that demand even more. The financial results didn't just beat estimates, they shattered them. For the current quarter, analysts expected revenues around $14.2 billion, but Micron's forecast came in at a staggering $18.7 billion. For earnings, Wall Street projected $4.78 per share. Micron's guidance is nearly double that, at $8.42. However, if you zoom out, you'll see another layer of strategy at play. Technology is usually seen as a deflationary force, making things cheaper, but Micron's massive pricing power is a leading indicator of new inflationary pressures coming from core tech components, complicating the Fed's fight against inflation. The results were so explosive that Morgan Stanley declared it the best revenue and net income upside in the history of the US semiconductor industry, with one massive exception, Nvidia. This is where the situation takes a more complex turn. The success of both Nvidia and now Micron points to a growing systemic risk. The entire global AI build-out is becoming intensely concentrated on a few choke point firms, elevating the risk that a single disruption could have cascading negative effects. For our audience in the Chinese-speaking world, there's another important layer to this. The incredible demand for Micron's advanced HBM underscores the widening technology gap facing China's domestic chip makers and raises the stakes for Beijing's state-led investment. This is creating a risk of future supply gluts in legacy chips, while the high-end market that Micron dominates remains out of reach. Ultimately, AI infrastructure is scaling faster than the supply chain can handle. While Wall Street focused on chip designers, this report signals a new reality where memory suppliers are at the center of the action. So what comes next? We need to watch if this intense AI investment starts crowding out capital from other economic sectors, creating a bifurcated economy of AI haves and have-nots. The focal points will be the earnings reports from other AI ecosystem players and, importantly, the producer price index for semiconductors, which will tell us if this tech-driven inflation is becoming a lasting trend.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.